viewers and welcome to first PUC Accountancy class. In today's class, I will be taking up the third chapter in your syllabus, that is Recording of Transactions Part 1. In the previous two chapters, that is chapter 1 as well as chapter 2, we have already studied what exactly is accounting, the theoretical aspects of accounting, accounting concepts or accounting conventions, and we have studied in detail about accounting standards and IFRS. So, now we already have enough knowledge or sufficient knowledge about accounting and about the accounting concepts and how exactly accounting is being practiced. So, in third chapter, that is Recording of Transactions Part 1, we will be studying about the practical aspects by applying those theories or the accounting concepts and conventions or other theoretical aspects, how exactly the accounting is being practiced or how the transactions are being recorded, how they are classified into different accounts, and all these things we will study in detail in this particular chapter. So, we will take the first aspect of this particular chapter, that is accounting equation. While studying accounting concept, we have studied one concept called as dual aspect concept. As per the dual aspect concept, in every transaction there will be two accounts involved, or a particular transaction will be recorded in two separate places or two different accounts. And based on this dual aspect concept, we have derived at an equation which is called as an accounting equation. Now, accounting equation establishes the relationship between the components of a balance sheet. Balance sheet is an account or financial statement. Balance sheet is a financial statement which has to be prepared by every business organization. It is compulsory. Now, what are the things that are recorded in the balance sheet? Balance sheet has two sides. One is the liability side and one more is the asset side. In the liability side, all the liabilities or the responsibilities of the business are being recorded, including the capital contributed by the owners. And on the asset side, all the assets or resources which are owned by the business organization are being recorded. So, accounting equation depicts the relationship between the components of the balance sheet. The components are nothing but the assets which are owned by the business, liabilities or the responsibilities of the business, and owner's contribution, what we call as capital in the business. So, it establishes a relationship between these three important components: assets, liabilities, and the capital amount. Since the accounting equation shows the relationship between the components of the balance sheet, the particular equation is also called as balance sheet equation. Balance sheet equation. Accounting equation signifies that on a given date or as on a particular date, the assets or resources which are owned by the business organization must be equal to the liabilities and owner's contribution. Or in simple terms, on a given date, the assets of the business organization must be equal to the liabilities and the capital amount. The accounting equation goes like this: A is equal to L plus C. Now, this is the accounting equation which shows the relationship between the components of a balance sheet. In the equation, A stands for the assets which are owned by the business, L stands for the liabilities or the responsibilities of the business organization, and C stands for the capital, or which is also called as owner's contribution or owner's equity. So, as per the accounting equation, on a given date, whenever you compare the assets or the resources of the business organization must be always equal to the amount of liabilities plus the amount of capital which is invested by the owners. By using this accounting equation, we can find out the missing balances of any components in the balance sheet. For example, in the balance sheet, you know the value of assets and you know the value of liabilities. You know the value of assets and liabilities, but you do not know the value of the capital. Amount of capital is not known. Then by using this formula, you can find out the amount of capital. The formula is A is equal to L plus C. In the formula, you know what is A and what is L. It is already given. Asset amount is given, liabilities amount is given, but the capital amount is missing. Now, you have to find out the amount of capital. So, capital is equal to, you know the value of total assets, the resources which you are owning. From the total assets, you deduct the value of your liabilities or the responsibilities, the remaining amount will be the capital. I will give you an example. The assets which are owned by the business organization are 10 lakh rupees. Assets which are owned by the business are 10 lakh rupees. The responsibilities of the business organization are 7 lakh rupees. From your assets, you deduct your responsibilities or the liabilities, 10 lakh minus 7 lakh, the remaining balance is 3 lakh rupees. So, this 3 lakh rupees is the amount of capital. In the same way, any missing figure or any missing component in the balance sheet can be easily found out by using the accounting equation. If they are given the value of asset and liability, you have to find out the value of capital. If the value of liability and capital is given, but the asset value is not given, total of liabilities plus capital will give you the value of the total assets. If the amount of asset and capital is given and the value of liability is missing, from your assets deduct the amount of capital, you will get the value of liabilities. So, any missing component in the balance sheet can be found out using the accounting equation. Therefore, it signifies the relationship or it establishes a relationship among the different components of the balance sheet. Therefore, it is called as a balance sheet equation or popularly known as accounting equation. We will understand this accounting equation by solving a problem. The question link is provided in the description of the video. Kindly refer the same. Now, the problem has been given related to a particular business organization. Rohit started business by investing capital of rupees 5 lakh. Already a business has been started by a person called Rohit and he has invested 5 lakh rupees into his business in the form of cash. Now, the two accounts involved are cash account and capital account. So, when he has started the business by investing cash, two accounts which are involved in the transaction are cash account and capital account. So, before entering into any other transaction, the accounting equation has to be shown. The effect of such transaction has to be shown in the problem. So, he has started business by investing a cash of rupees 5 lakh. So, cash is an asset. So, on the asset side in the cash column you will record 5 lakh rupees. He has invested capital. So, to that extent capital value also increases, capital 5 lakh rupees. So, before taking into account any other transaction, when we see the problem, the asset side is showing 5 lakh rupees, that is in the form of cash, and the liability side is also showing 5 lakh rupees in the form of capital. So, it is equal. So, write the amounts in the total columns. Total asset is 5 lakh rupees and total liability is also 5 lakh rupees. The next transaction, opened a bank account in State Bank of India with an amount of rupees 4,80,000. He has invested 5 lakh rupees into his business organization. Out of 5 lakh rupees, now he has deposited 4,80,000 into his bank account. Cash is going into bank account. To that extent, cash balance will reduce and bank balance will increase. Bank balance will increase. So, the two accounts involved are cash and bank account. Cash is also an asset, bank is also an asset. One asset balance is reducing, that is cash, and one more asset balance is increasing in the form of bank account. Now, you have to record this in the form of an equation. So, the first transaction, transaction number 1, post transaction equation. That means, after taking into account the transaction, what is the accounting equation? We call it as post transaction equation after considering. So, he had 5 lakh rupees of cash, out of which he has deposited 4,80,000 into bank account. Cash is going out, cash balance will come down. So, when the cash balance or the asset balance reduces, you have to deduct it from the cash. 4,80,000 is deducted. So, you are deducting, write it in the bracket. So, 4 lakh So, 5 lakh minus 4,80,000, remaining balance of cash is 20,000. 5 lakh minus 4,80,000, remaining balance is 20,000. Now, this 4,80,000 is deposited into bank account. So, to that extent your bank balance will increase. So, bank balance will increase by 4,80,000. This 4,80,000 rupees of cash has been deposited into bank account. To that extent bank balance will increase. When the bank balance increases, it is showing a plus balance. So, bank balance will become 4,80,000. There is no value of debtors, stock or goods is not being involved in the transaction, no furniture, no plant and machinery, and there is no changes in the liability side, because the accounts involved are cash and bank. It will not have any effect on the liability side. So, it will remain same. Now, you have to calculate the total of assets and total of liabilities. On the asset side, you have 20,000 rupees of cash and 4,80,000 rupees of bank balance. You have to add this. Total of assets will become 4,80,000 plus 20,000 is 5 lakh rupees. So, in the assets total asset column 5 lakh rupees. Liabilities is 0, capital amount is 5 lakh rupees, same amount, and total of liabilities will be 5 lakh. So, this is the total. So, after recording the transaction, again the asset side of the business is equal to total of liabilities and capital. 5 lakh is equal to 5 lakh rupees. Now, it is equal. Second transaction, bought furniture for rupees 60,000 and check was issued on the same day. A furniture has been purchased and the payment is done by issuing a check. So, the two accounts involved are furniture account and bank account. Furniture and bank account. Bank because you have made the payment by issuing a check. Furniture is an asset, bank is also an asset. You are buying furniture, that means to that extent furniture value increases, the asset value increases. On the other hand, you are making the payment out of your bank balance, to that extent bank balance will come down or reduce. So, after taking into account this particular transaction, what is the accounting equation? So, second transaction, post transaction equation. After recording each transaction, you can draw a line so that there is no confusion. It becomes easy for you to record the remaining transactions. For your convenience purpose, you can draw a line after each transaction. So, second transaction, purchased furniture and payment is made by issuing a check, and the value of furniture is 60,000 rupees. Now, there is no cash account involved. So, cash account balance will remain same 20,000. So, in this transaction there is no cash account involved. So, cash balance will remain the same 20,000. You have made a payment by issuing a check, that means to that extent bank balance will reduce. The payment amount is 60,000, write it in the bracket. So, 4,80,000 minus 60,000, remaining balance is 4,20,000. 4,20,000. There is no value of debtors, no stock or goods. You have purchased furniture, so furniture value increases 60,000. There is no plant and machinery. Now, coming to the liability side, there is no changes. There is no liabilities or capital amount involved in the particular transaction. So, there will not be any changes. Liability value is still 0. Capital amount is 5 lakh rupees. Now, calculate the total of the assets. 20,000 rupees of cash, 4,20,000 of bank balance and 60,000 of furniture value. So, when you add this 20,000 plus 4,20,000, 4,40,000 plus 60,000, 5 lakh rupees. So, total of assets is 5 lakh. Liabilities 0, capital value 5 lakh, total is 5 lakh. Again, total of assets is equal to liabilities and capital. Third transaction, bought plant and machinery for the business for rupees 1,25,000 and advance of rupees 10,000 is paid in cash to Ramji Lal Limited. So, the total value of purchase is 1,25,000, purchase of plant and machinery. Now, machinery is considered as an asset in the business. So, an asset has been purchased, total value is 1,25,000. Out of this 1,25,000, 10,000 is paid immediately in the form of cash. Cash has been paid 10,000 and the remaining balance is not paid. That means, on credit basis you have the responsibility to pay to the supplier in the future. That means, they become a liability. You have the responsibility, they are the creditors and you have the responsibility to pay. Now, there are 3 accounts involved in the transaction. Now, there are 3 accounts involved in the transaction. The accounts involved are plant and machinery in the form of an asset, you are paid cash and Ramji is an creditor. You are supposed to make the payment on a future date. Now, after taking into account the particular transaction, what is the accounting equation or what are the changes in the assets and liabilities of the business. So, third transaction, post transaction equation. After the transaction, the equation is you had 20,000 rupees of balance, cash balance, out of which you are paid 10,000 to Ramji Lal immediately. So, 20,000 minus 10,000, remaining balance is 10,000. There is no bank account involved, it will not change. So, it will remain the same 4,20,000. There are no value of debtors, no stock or goods, furniture value will remain same 60,000. Now, you have purchased plant and machinery and the value of that particular machinery is 1,25,000. Asset value increases by 1,25,000. Now, plant and machinery account is being adjusted and cash account is being adjusted. Remaining is Ramji Lal account, who is an creditor, who has supplied the goods on credit basis. You have the responsibility to make the payment to your supplier of goods on credit. The total value of purchase is 1,25,000. Out of 1,25,000, 10,000 is already paid. Remaining balance is to be paid in the near future, that is 1,15,000. So, our liability increases to the extent of 1,15,000. So, on the liability side 1,15,000, the capital balance will remain same, there will not be any changes, 5 lakh rupees. Now, you have to add the total of all the assets and total of liabilities and capital. 10,000 of cash, 4,20,000 of bank balance, 60,000 of furniture and 1,25,000 of plant and machinery. When you add all this, the total will be 6,15,000. 6,15,000. On the other side, 1,15,000 of liabilities and 5 lakh rupees of capital amount. When you add this, again the total is 6,15,000. So, it is again equal. Fourth transaction, goods purchased from Sumit Traders for rupees 55,000. Your purchased goods, value of goods is 55,000 from Sumit Traders. The transaction clearly states it is a credit transaction. Payment is not done, has to be done in the future. So, the two accounts involved in the transaction are the goods or the purchases, or in the problem it is stock of goods, and Sumit Traders, who is an supplier of goods on credit basis. Now, goods have been purchased, goods are treated as stock in the business, So, to that extent our stock value increases, stock is an asset, to that extent asset value increases. On the other hand, we have the responsibility to make payment to Sumit, 55,000 rupees has to be paid to Sumit in the near future. Our liability also increases. So, after taking into account what is the accounting equation. So, fourth transaction, post transaction equation. purchased goods on credit basis. So, goods value increases by 55,000. There is no cash account involved, so the cash balance will remain same 10,000. There is no bank account involved, 4,20,000, no changes, no value of debtors and stock 55,000 we have recorded. Furniture value will remain same 60,000 and plant and machinery 1,25,000. So, asset side adjustments are done. Now, Sumit is a creditor, to that extent liability increases. So, on the liabilities 1,15,000 plus 55,000, it is plus. So, 1,15,000 plus 55,000 is 1,70,000, 1,70,000. Capital amount there are no changes, 5 lakh rupees. Now, you have to add the total of liabilities and asset side. 10,000 plus 4,20,000 plus 55,000 plus 60,000 plus 1,25,000. So, the total will be 6,70,000. Total of asset is 6,70,000. Now, coming to the liabilities side, 1,70,000 of the liabilities and 5 lakh rupees as capital, 5 lakh plus 1,70,000, 6,70,000. So, again capital side is also 6,70,000, it is equal. So, after making the adjustments or after taking into account the transaction, the accounting equation. Next transaction, transaction number 5. Goods costing rupees 25,000 sold to Rajani Enterprises for rupees 35,000. In the transaction, there is no information about the cash. Goods costing rupees 25,000 has been sold to Rajani Traders for rupees 35,000. That means sold at a profit margin. Now, the accounts involved in the transaction are goods we have sold, Rajani Traders who is a debtor, we have the right to receive from Rajani Traders and we have sold at a profit margin. So, the profit amount, 3 accounts are being involved. So, after taking into account this particular accounting transaction, what will be the accounting equation? We have sold the goods worth rupees 25,000 for rupees 35,000 to Rajani Traders. So, out of the goods, the sales value has to be deducted. To that extent, goods will go out from the business organization. The value of goods sold is 35,000, which is costing rupees 25,000. So, fifth transaction, post transaction equation. There is no cash account involved, cash balance will remain same 10,000. There is no bank account involved, bank balance 4,20,000. Now, we have sold goods worth rupees 25,000. To that extent, goods value will decrease. So, 25,000 has to be deducted, write it in the bracket. 55,000 minus 25,000, the balance is 30,000. Balance is 30,000 and we have sold it for rupees 35,000 to Rajani Traders. We have the right to receive rupees 35,000 from Rajani in the near future. That means it is an asset, asset in the form of debtors. 35,000 of debtors value has to be recorded. So, debtors will increase by 35,000, debtors will increase by 35,000. So, actual value of goods is 25,000, sold for 35,000. We have sold for more price. That means the difference of these two amounts is a profit, and profit is a part of capital. Profit is always enjoyed by owners. Therefore, it is a part of capital, has to be added to the capital amount. So, on the liabilities there are no changes, 1,70,000. In the capital column, 10,000 rupees of profit has to be added. So, after adding 5 lakh plus 10,000, 5 lakh 10,000. Now, calculate the total of assets and total of liabilities. 10,000 plus 4 lakh 20 plus 35,000 plus 30,000 plus 60,000 of furniture and 1 lakh 25,000 of plant and machinery. On the other side, 1 lakh 70,000 of liabilities and 5 lakh 10,000 of the capital amount. So, total is 6 lakh 80,000, 6 lakh 80,000 on both asset side as well as liabilities side. So, again after taking into account the particular transaction, the balances of the liabilities and capital is equal to the total of the assets. So, all the transactions are being recorded, all the 5 transactions related to business are being recorded. After recording all the transactions, you have to write the final balances of all the accounts, that is the final equation. Final equation. $10,000 of cash, 4,20,000 of bank balance, 35,000 of debtors, 30,000 of stock, 60,000 of furniture, 1,25,000 of plant and machinery, 1,70,000 of liabilities, 5,10,000 of capital, and total is 6,80,000 on both the sides. So, this is the accounting equation which shows the relationship between all the components of a balance sheet, the assets, liabilities and the capital value. After recording every transaction, the balances of the assets should be equal to the total of liabilities and capital. Thank you so much.